October just wrapped up, and it was the sixth straight month of gains for the S&P 500. But not everyone joined the rally. Dividend stocks, and my high-yield watches in particular, finally ran out of steam. So in today's video, we'll recap what happened in the markets, how the watches performed, and what's changed going forward, including 2 new experimental portfolios designed to test quality and value tilts. The S&P 500 ETF, ticker symbol SPY, gained 2.38% in October, marking 6 consecutive positive months. That puts SPY up roughly 17% year to date. Vanguard's high dividend yield ETF, ticker symbol VYM, didn't keep the streak alive this time. It dipped 0.26% for the month. And my top 10 high yield dividend stocks, the strategy I've been tracking since 2020, fell 1.1% in October, extending the downtrend that started in September. Since inception, though, the results remain strong. My watchlist CAGR stands at 14.49%, compared to 15.34% for VYM and 17.44% for SPY. So yes, it's lagging the index, but it offers twice the starting dividend yield of VYM and 3 times that of SPY. That trade-off, more income for slightly lower total return, is exactly the balance this project was designed to test. For anyone new to this series, the main purpose of the watchlist is to find investment ideas. Each month, I screen high-quality, dividend-paying companies that appear undervalued with a decent starting yield. Performance is tracked versus SPY and VYM to see how effective the stock selection process really is. But the long-term goal is simple: to maintain a 12% annualized rate of return over time. In October, I made one small change. The minimum dividend yield threshold was reduced from 2.75% to 2.5%. This widened the universe of quality companies and gave me a deeper pool of candidates to choose from. For November, there's only one change in the top 10 list. Pepsi is out, and NextEra Energy takes its place. But that's not the only update. This month, I'm expanding the experiment. You'll now see 3 portfolios side by side: the original method, a quality-focused version, and a value-focused version. Let me tell you which stocks were chosen for each portfolio, and then we'll take a look at how these portfolios differ. These are the 10 original selections: Accenture, EOG Resources, Paychex, Penske Auto Group, UPS, Merck, Comcast, Essential Utilities, NextEra Energy, and Brown-Forman. For the pure quality-focused portfolio, we drop UPS, Comcast, and Brown-Forman, and they are replaced by PNC Financial, Union Pacific, and State Street. Now, for the pure value-focused portfolio, we drop Paychex, Penske Auto Group, Merck, Essential Utilities, and NextEra Energy, and they are replaced by Eastman Chemical, American Waterworks, T. Rowe Price Group, McCormick, and PPG Industries. The pure quality-focused selections focus on better long-term track records of financial growth, while the value-focused selections focus on stocks that are potentially more undervalued. And the original list blends these 2 factors together. I think it'll be interesting to see which focus leads to better long-term returns. If you'd like to take a closer look at this table, you can check out my free newsletter, linked below. I share this list with my free subscribers at the end of each month. And a little bit later in the video, I'll go through the original 10 selections in a bit more detail, and I'll show you the historical dividend yield theory chart and dividend growth history for all. Now, let's take a look at how each of these portfolios differs. Here's how the numbers shake out. In terms of forward dividend yield, the original selections have a forward yield of 3.86%. The quality-focused selections have a yield of 3.26%, and the value-focused selections have a yield of 4.05%. In terms of potential undervaluation based on dividend yield theory, the original selections are potentially 37% undervalued. The 10 quality selections are potentially 24% undervalued. And the 10 value selections are potentially 43% undervalued. In terms of the 5-year dividend growth rate, the original selections have a growth rate of 12.3%. The quality-focused selections have a growth rate of 12.2%. And the value-focused selections have a growth rate of 10.5%. And finally, let's take a look at the expected rate of return. The 10 original selections are expected to return 15.36% per year over the next 3 to 5 years. The quality-focused selections have an expected rate of return of 15.74%, and the value-focused selections have an expected rate of return of 14.76%. So the takeaway: the quality version favors better growth and higher projected returns, while value leans into yield and discount to fair value, and the original remains the balanced middle ground. Now let's talk results. October was a weak month, but if we zoom out, the picture is still solid. Since inception, the strategy has returned 96.7%, comfortably beating my 12% annual return goal. Breaking it down by year, in 2020, the strategy was up 16.4%. In 2021, it was up 26.3%. In 2022, it dipped by 11.9%. In 2023, it was up 22.1%. In 2024, it was up 18.8%. And in 2025 so far, up 4.7%. That's a 14.49% annualized return, just shy of VYM's 15.3% and SPY's 17.4%. But again, with higher income and solid downside resilience. Here's how the individual stocks performed last month. Accenture was up 1.42%. Brown-Forman was up 0.55%. Comcast fell by 11.43%. EOG Resources fell by 5.6%. Merck was up 2.44%. Penske Auto Group was down 7.96%. Paychex declined by 9.09%. Pepsi was up 4.02%. UPS was up 15.43%. And Essential Utilities fell by 2.18%. And the best overall performers across the entire 5-year history are: number 1, Broadcom, up 790%. Number 2, JP Morgan, up 260%. Number 3, Bank of New York Mellon, up 258%. Number 4, General Dynamics, up 191%. And number 5, Corning, up 181%. On average, 81% of all stocks ever included have produced a positive total return since being added. And when weighing more frequent appearances, that success rate jumps to almost 88%. Now let's quickly walk through the top 10 stocks for November. First up is Accenture, that trades at a potential 67% discount. It offers a 2.61% yield, and it has a 21% expected return. Accenture has a very good track record of dividend growth, maintaining a double-digit growth rate during the past decade. The stock has struggled in 2025, and as indicated by dividend yield theory, may be trading for a sizable discount to fair value. Accenture is also sporting one of its highest dividend yields during the last 7 years. Number 2 is EOG Resources, that trades for a potential 40% discount. It pays a 3.85% yield, and has a 13.6% expected return. EOG also has a strong dividend growth record, with double-digit long-term dividend growth rates. The stock has traded flat for the past few years, so naturally, the dividend growth has pushed its yield significantly higher. Number 3 is Paychex, that trades for a potential 32% discount. It pays a 3.7% yield and has a 17.2% expected return. The stock has struggled for a few months now, offering investors higher dividend yield entry points along the way. Long-term dividend growth has been great, with the 2 through 12-year CAGRs all above 10%. Number 4 is Penske Auto Group, that trades for a potential 49% discount. It pays a 3.45% yield and has a 16% expected return. Penske has traded flat for about 2 years now, and the share price has diverged from its implied fair value measured by dividend yield theory. The yield has also crept higher due to above-average dividend growth. The company did suspend its dividend in 2020 during the pandemic, but dividend growth picked right back up in 2021. Long-term dividend growth has been very high, sitting close to 20%. Number 5 is UPS, that trades for a potential 72% discount. It pays a healthy 6.8% yield and has a 19.4% expected return. The stock has declined since about 2022 and seen its share price cut in more than half. Dividend growth has also slowed down to a crawl, with the last 2 years seeing sub 1% increases. Long-term dividend growth has been solid, sitting just under 10%. The declining price and the modest dividend growth have pushed the stock's yield to all-time highs, reaching nearly 8%. More recently, the stock has bounced higher, and the yield has dipped a bit. but there is still a lot of uncertainty around the company's future growth potential. Number 6 is Merck, that trades for a potential 20% discount. It pays a 3.77% yield and has a 17.8% expected return. Merck was on a freefall during late 2024 into early 2025. However, since April, we have seen a modest reversion, but dividend yield theory still suggests the stock is trading below its implied fair value. Dividend growth has been modest and slowly cooling off. The long-term dividend CAGR is around 7%, with more recent increases of about 3 to 5%. Merck is still offering a historically high yield today, although a few months ago we did see the yield cross north of 4%. Number 7 is Comcast, that trades for a potential 72% discount. It pays a 4.7% yield and has a 17.5% expected return. Comcast is another sideways moving stock, and 2025 has not looked pretty thus far. Dividend growth has been strong, but it is slowly cooling off. The long-term dividend CAGR is just north of 10%, and more recent increases have been in the range of 7 to 8%. The sideways price movement for the stock, coupled with a growing dividend stream, have led to Comcast paying a historically high dividend yield today, edging closer to 5%. Number 8 is Essential Utilities, that trades for a potential 23% discount. It pays a 3.5% yield and has a 14.6% expected return. And we have another sideways moving stock, but this time with rather steady dividend growth. The 3 to 12 year dividend CAGRs are all sitting slightly above 7%. And again, this combination of price movement and dividend growth have led to a historically high dividend yield for the stock, sitting right around 3.5%. Number 9 is NextEra Energy, that trades for a potential 10% discount. It pays a 2.8% yield and has a 13% expected return. The stock struggled between 2022 and early 2024. Since then, investors have seen a strong recovery with some sideways movement earlier this year and a large spike more recently. Dividend yield theory is still telling us the stock is marginally undervalued. Dividend growth has been strong, with the last 10 years all seeing double-digit increases. NextEra Energy is a sub 3% yielder, but the current yield is still above the trailing 5-year average of about 2.5%. And finally, number 10 is Brown-Forman, that trades for a potential 110% discount. It pays a 3.3% yield and has a 19.9% expected return. The bulk of this return is tied to the potential undervaluation, so it is largely based on the company being able to turn the ship around. The stock has struggled since 2021, losing nearly 2/3 of its value. Dividend growth has also slowed down, with a modest long-term CAGR of about 5%, and the most recent increase being sub 3%. During the past 7 years, Brown-Forman was mainly a sub 2% yielder, but more recently, due to the share price falling, the dividend yield has crept north of 3%. I know that most of these companies don't look great in these charts, but fundamentally, there are still solid businesses with long-term revenue and earnings growth. And if you're going to look for undervalued deals in the market, you need to look at companies that are struggling or out of favor. Obviously, you need to perform your own due diligence before making any decisions. And keep in mind, this is just a list of potential opportunities that are sporting better than average dividend yields relative to their own histories. And that wraps up the November 2025 update. If you'd like a deeper dive into how this watchlist is built, check out the first video in this series where I break down the stock screening and evaluation process in detail. If you enjoyed the content, please like and subscribe. And don't forget to check out my newsletter, Quality at a Fair Price, for more of my dividend stock analysis. Thank you for watching and see you next time.